Ever sat back and pondered over how bond investments function? Picture this: you're lending money to an entity, like a government or corporation. They promise to pay you back, with interest, by a certain date. Exciting, isn't it? But how does all this happen? Imagine you're lending a friend a hefty sum. You'd want some interest, wouldn't you? That's the essence of bond investments. You, the investor, lend money to a corporation or government. They promise to pay you back with interest. This agreement is a bond. Over time, you receive interest payments, and when the bond reaches its maturity date, you get your original investment back. It's a steady, predictable income stream. So, you've lent your money and you're earning interest. But what's next? Like any investment, bonds are not without their risks. Interest rate risk, for instance, means that if rates rise, the value of your bond could fall. Credit risk involves the potential for the bond issuer to default. There's also liquidity risk, the chance you might not be able to sell your bond when you want. Nevertheless, despite these risks, bonds are generally seen as safer than stocks, providing a steady stream of income. Risk is part of any investment, but with bonds, you're playing a safer game. So, what should you remember about bond investments? Essentially, bond investments are loans you make to an entity, earning income through interest. They carry certain risks, yet are generally safer than stocks. Bond investments might seem complex, but once you know the basics, it's a game you can play.